Hey everybody, welcome to Mortgage Today for Tuesday, February 13th, 2024. And oh, what a day it was. We had a rough open on the bonds. It was down 45 basis points early. The core month-over-month CPI came in at 0.4 and a 0.3 forecast. It was 0.3 previously, so it's moving the wrong direction. Core year-over-year CPI came in at 3.9 versus a 3.7 forecast. It was 3.9 previously. Yes, this is bad for rates. Not only is the monthly headline 0.1% higher than expected, but due to rounding and the fact that the underlying numbers have more decimal places, the annual number is 0.2 higher than expected. 10-year yields were instantly 7 basis points higher on the day. The figures further reduce the already slim chances that Fed officials will start lowering rates anytime soon, and any additional deceleration might reignite talks that they will resume hikes. Some policymakers have said they want to see a broader easing of price pressures before cutting rates. The 2023 quarter four consumer debt rose $212 billion. Mortgage balances increased $112 billion. HELOCs rose $11 billion. Credit card balances added $50 billion. Auto loans were up $12 billion, and other balances such as retail cards and consumer loans increased $25 billion. The 2023 quarter four spending was up $208 billion, meaning that over 100% of the rise in consumer spending was debt financed, not a sign of healthy households. Over the course of the past 2 weeks, and especially the last few days, there's been much focus on today's CPI release that it may be bordering on annoying. A few things are more annoying, however. Today's example is a bond market that is incredibly eager to confirm that CPI deserved every bit of the recent hyper-focus. By the time we consider that the big jobs number earlier in the month hit when yields were low enough to offer little argument of correction, today's CPI reaction is larger and more significant by any order of magnitude. The heretofore ceiling at 4.19 in 10-year yields was immediately shattered, and we now find ourselves in the weakest levels in 2 months, resigned to wait on other economic data to tell a more rate-friendly story. So at the end of the day, the UMBS was up 63 basis points at 100.08. So at 100.08 is putting us way down in this range below the 200-day moving average, slightly above the 100-day moving average, and below a whole new Fibonacci line that we haven't seen for quite a while. And we also got big mortgage news. The Guild strikes a deal to acquire Academy Mortgage. So Guild Mortgage struck a deal to acquire rival mortgage Academy Mortgage, which could result in an additional 800 plus loan officers across the country. During an all-hands call, Academy's leadership informed employees about the M&A deal, which is expected to close mid-April. Academy CEO Adam Kessler told staffers that he's been seeking for either private capital or an acquirer for a while. This does not make any sense to me. They have probably funded somewhere close to $30 billion worth of loans over the last 4 years, and they need money? I mean, how is a company that could possibly need money after making that much money worth buying? We also got a post from our sponsor at thatmakesense.com. This is reading notes from No Excuses by Brian Tracy. So this is all about how you can make your future happen using discipline and a disciplined approach to your business. So check it out on our website at thatmakesense.com.